Good morning. Good morning, everybody. So, if this is your first time joining my live, I'm Chanel Jones with Savvy Taxes and Business Consulting. Definitely check out our page, like it and share it, please. Follow us because we have some really great information on there, some things that you can benefit from for this tax season, and you can also go back and look at the information on our page, and you'll be able to adjust your plans. Good morning, Danielle. Adjust your plans for next year. So this morning we're talking about taxes. Okay. So yeah, good morning. Thank you so much for joining. Um, so we're doing. Everybody has heard of the Tax Act already. So Trump really in 2017 put in place for 2019 actually the um, the Tax Cuts and Jobs Act. So good morning, Willie. That was yay! Willie is a new affiliate with Savvy Taxes. Thank you so much for joining. I had to double. I did a double take. So with that being said, he really changed the tax code as we knew it. So I'm going to talk about a couple things today. 13 things to be exact. Good morning, Stacy. 13 things to be exact that can help you, make some better moves for the next tax season or for the next year. So if you're a businesswoman or a man and you like planning, it's definitely better to plan ahead. So for this year, I'm already planning my second quarter for 2020. So definitely do that because time is moving and you don't want to get caught up in some things that you could have changed now. So the first thing you want to do for one of your best moves, some of these things are extreme. I did a little research this morning. Good morning, Romello. Thank you so much for joining. I did a little research, right? Some of these things are extreme. However, it could be really good for you. So the first thing you want to do is adjust your tax withholdings. If you have a 9 to 5, if you have a job, if you have a W-2, go to your HR department and adjust those withholdings. So I'm reading now. For example, beginning of the year, personal exemptions have been eliminated, right? That's gone. You used to get, I think it was like $44,000. That's gone. However, the standard deduction has been increased for singles. It was $6,350, and it's increased for married couples. It used to be $12,700. Now it's $24,400. I benefit because I'm married, though. But anyways, that goes across the board. So you want to talk to your HR department and adjust some of those things so you can prepare for next year. The second thing you want to do is increase your 401k contribution. So again, these are for employed. Good morning, Jessica. Thank you. Thank you so much for joining. I appreciate y'all. I hope y'all know that. So the second thing you want to do is increase your 401k contribution. It has increased $500 more, so you want to max that out. Okay. So I think it used to be 55 for the okay. That's for 50 people, 50 and older. So you want to max it out. It changed for all other tax brackets, 18,500, and it moved up in 2019 to 19,000. So if you can, go ahead and max that out. The number 3 is increase your IRA contribution. I'm reading. The $500 retirement plan increases also applies to the IRA accounts. The IRA contribution maximum is increasing from $5,500 to an even $6,000. So, tip number 3. Consider this is the extreme thing. However, it can work. Consider relocating to a tax-friendly state. Y'all want to know what those states are? Good morning, Ali. Those states who are tax-free is Alaska, Florida, Nevada, New Hampshire, South Dakota. Ain't nobody going to South Dakota. Tennessee, Texas, Washington, and Wyoming. All of those places. So, yeah. If you're looking to make a move or something that's really drastic, those are some places that you can go to take advantage of the tax-free states. So, yeah, about that. You may want to consider that because also they have what is called the SALT. which is it's a limit on your local and your state taxes. So if you bought a home, then that's really going to affect you because you probably won't be able to deduct as much. So they put a $10,000 cap on what you can deduct. So that's where they're saying. So if you live in places like California or some New York, some high tax states, then that'll definitely really affect you. So they're probably talking about those people. Number 5 is set up an HSA account. That's a health savings account. Let me see. I'm reading. Under an HSA, you can make a tax-deductible contribution of $3,500 for single and up to $7,000 if you have a family. So that's more deductions that you can take just with having or opening up an HSA account. Kind of like an FSA too. So the number 6 tax tip is to plan to fully use your flexible spending account. That's the FSA. Good morning, Ronnie. Thank you so much for joining. I appreciate y'all. I really do. So this one says FSAs, which is a flexible spending account, and are similar to HSAs. So if you are, again, if you're employed, you know what those terms are. So the HSA is a health savings account. The FSA is similar to that, but they have a smaller contribution limit. I'm reading. There's no change here under the new tax laws. Though there are some exceptions employers can provide, they are limited in scope. Good morning, Pete. So they're kind of one and the same, but one of them, the FSA. See, that's too much. That's too much. FSA, HSA. I have to really think about what I'm saying. So, anyways, the flexible spending account. The only difference is it has a smaller contribution limit. That's all. 7. If you're buying a new home, watch the price. This is what I was talking about when I was talking about the SALT cap. So here, I'm reading, the new tax laws limits the mortgage interest deduction to interest paid on the home loans, not to exceed $750,000. So if you're planning to buy a home in 2019, this was an article that I found, so this still applies in 2020, because the tax laws changed, and with the big change, it's not changing anytime soon. So, yeah. With that being said, if you're planning to buy a home, even in 2020, and you're looking at the high-end market, keep the mortgage limit in mind. It's a substantial reduction for the one. Good morning, Michelle. And thank you. Good morning, Pete. It's a substantial reduction from the $1 million indebtedness permitted under the previous law. So basically, that's saying you had $1 million, right? It was capped at $1 million. Now you can exceed $750,000. So that really applies, like I said, if you're in higher tax brackets, or if you're in those states with extremely high taxes. Can you upload links to articles you're reading? I sure can. I'll definitely do that. Yep, I sure can. Yep, so Willie asked me to upload links to the articles. Yeah, I'll definitely do that after, and you can follow along. I should have did that before. That's a good idea. So number 8 is, if you're starting a new business, discuss the business entity type with your CPA, because the different codes or the different entity types can make or break your business. So I know a lot of people who start businesses and they do sole proprietor. That would probably be the least recommended entity that I would give a client personally, because you have absolutely no protection. So between that, you have sole proprietorship, you have an LLC, you have an LLC with an S corp, you have, good morning, Lamar, you have a corporation. So it's a distinct difference between all of those, and they provide the business owner with different coverage, leverage, protection. So if you're starting a business, you definitely want to talk to your CPA or come holler at me if you have some questions. Number 9 is be ready to make estimated tax payments on extra income. I'm reading. The changes in tax rates standard. Thank y'all for the hearts. I appreciate it. Y'all so sweet. The changes in tax rates, standard and itemized deductions, the elimination of personal exemptions, and other tax changes can have a major effect on your tax liability. Just as you need to adjust your withholding tax accordingly, You'll need to do the same with estimated tax payments on any income you earn that isn't subject to withholding. Did y'all get that? My husband say I read too fast sometimes, so if you didn't catch it, let me know. We can discuss it later. So basically all that's saying is if you're making extra money, get ready to make some estimated tax payments to the IRS in layman's terms. 10, and I'm almost done. If you're thinking of making a Roth IRA conversion, now is the time to set it up. So I'm reading again. A Roth IRA conversion is where you convert tax-deferred retirement plans like 401ks or IRAs where they ultimately provide tax-free income in retirement. Everybody wants that. So if you don't have an IRA or a Roth IRA or 401k, definitely put some money aside. I'm not saying put it in the bank. What I'm saying personally, I'm saying invest. That's what I do personally. Everybody to each his own. But when you have your money just sitting in the bank in a savings account, take this how you want to take it. The banks are making money off of you. They are investing your money, and they're making, good morning, Javar, they're making hundreds of thousands, millions of dollars based off your savings account. So they're trading your money back and forth. I say, personally, you can take that money and trade it yourself and invest in something yourself where you create not only a second stream of income, but you're also creating money for retirement. Because you invest in something, stocks, if you're trading, a business, that's going to always continuously feed you. But what is your percentage if you got your money like, how much, what is the percentage like, 0.0007? I don't know, because I don't have that. But what type of money are you making from having it sitting in the savings account? Think about that. The banks are making money, but you're probably making, good morning, Laura. I don't know, I don't even know. But just think about that. If you have a large savings account, first of all, I wouldn't put more than $10,000 in one bank as a saving. But if you have the money sitting there, consider investing it, and that's just friendly advice. So anyways, number 11 is take advantage of expanded opportunities with the 529 plan. What is that, Chanel? I'm reading it now, and I'll put the link in there so you guys can see as well. Yeah, thank you, Pete. I'm trying to help the people today. Okay, so that's, good morning, Michael. Thank y'all. So with the 529 plan, I'm reading, there's good news here under the new tax law. Under the previous law, funds from the 529 plan or the savings plan could only be used to pay college level costs. But starting in 2018, the plan has been expanded to allow the use of up to $10,000 in the 529 plan to pay for tuition for grades K, which is kindergarten through 12th grade. So all they're saying in layman's terms, because I'm always just break it down for my understanding and yours, is the 529 plan allows you to use the $10,000 for your kids, right, for kindergarten through high school instead of just college. That's all it's saying. Number 12, and I have one more and I'll be done. Get your employer to switch to a reimbursed employee business expense plan. This does not apply to everybody. It just really depends on what type of job you have. So with that being said, research, a reimbursed employee business expense plan. Because it does not apply to everybody. It just depends on what type of job you have. The last thing is to prepare for changes in the alimony. So these are for, of course, alimony. You're talking about divorced couples. So I'm going to just read here and see if it applies to you. Then, you can't do anything about it. You just got to go with the rules because this is what it is. Okay, so I'm reading. Under the old tax law, alimony was deductible for the payer. So if you're paying money to your spouse, and it was taxable for the recipient, okay? So if you're paying money to your spouse, then you were able to deduct it on your taxes. Good morning, Tyrone. Hey, cousin. And if you were the recipient, like if somebody was paying you child support, then you have to report that as income on your taxes. Okay, so the new law, we're getting up to date now. The new law will apply to the divorce decrees after December 31st of 2018. So if you're getting a divorce this year, this was last year, an article. So if you're getting a divorce, you'll be paying alimony, and you will no longer be able to count that as a tax deduction. Thank you, Tyrone. I promise you, I'm trying. You'll have to adjust your tax withholding or tax estimates accordingly. There is one loophole in the change, though. For divorcees prior to January 1st, 2019, alimony will continue to be deductible for the payer and taxable to the recipient. So I hope that makes sense. That last thing, I'll break that down for you. All that means is after December 31st of 2018, basically, if you were paying for child support, then you were able to deduct that on your taxes. If you were getting child support, you have to report that as income. Okay? Good morning, Janine. That's all it's saying. So, those are the 13 tax tips or the 13 best tax moves that you can use for next year. If these things apply to you, take advantage of it and start planning for it now. It's always better to plan, like I said earlier in the live. I'm planning second quarter right now for next year. So just stay ahead of the game. And if you have any questions, just let me know. Willie, I thought that was a great thing. I will post this article that I found so you guys can have the information for yourselves. You can read it, break it down. If it applied to you, you can go back to it. So thank y'all for joining. Today was all about taxes because y'all know I do taxes. And I have an affiliate program as well if you're interested in joining. Our lowest package was $300. That went to $99 for the Black Friday and Cyber Monday sales. So if you're interested, now is definitely the time to get in because you're only paying $100 for all this information to make thousands of dollars during the tax season. So I'll list the information for you if you're interested, and I'll also list the article right after this live. If you have any questions about taxes or corporations and incorporating, just let me know, and we can discuss those things. But thank you all for joining, and I will definitely catch y'all tomorrow.